structured cash ISAs, growth deposit plans, guaranteed capital plans, guaranteed income bonds, protected investment funds. The important thing to know about structured products is that they use financial derivatives to provide that protection or guarantee. Now, as soon as I say the word derivatives, I know alarm bells are ringing in your head. Derivatives are high risk, aren't they? Well, they certainly can be. The funny thing about structured products is that they use derivatives to try and bring order into chaos, to try and structure a defined return out of a very unruly environment, the stock markets. Even funnier, they don't actually invest in stocks and shares. Here is a simple example of how a 6-year structured product might work. This plan offers you your money back after 6 years and to pay you a proportion of the rise in the FTSE 100 on top. This proportion will be stated from the start so you know where you are. The bulk of your money, as much as £85 of every £100 you invest, goes into a zero coupon bond to ensure your capital can be repaid. Zero coupon sounds scary, but all it means is that the bond won't pay any interest but will simply grow enough so that your £85 is worth £100 in 6 years' time. Meanwhile, the rest of your money is split in two ways. The first buys a derivative contract called a call option on the FTSE 100. This is the bit that provides the proportion of the growth in the FTSE 100 that you are owed. Essentially, the product is buying its growth in advance. It's a pretty neat arrangement. Structured products can be useful for people who need a certain amount of money at a set point in the future, for example, for school or university fees. People coming up to retirement can also use them as a way of keeping their pension savings invested whilst protected from a stock market crash. The basic setup I've explained can also be modified to suit different needs. For example, you can buy plans that will offer less than 100% capital protection but more growth. Or you can buy income plans that turn that preset capital growth into a series of regular payments.